Generally speaking, traders don't take too much notice of holiday-affected trading. Players are on the sidelines. Market reactions might not be a true reflection of overall market sentiment. So looking at last week's action, we have to remember that much of Asia was on holiday for almost the whole week. And we also had holiday-affected trading in North America with both the US and Canada on holiday on Monday. So while we will look at the record, and of course the chart is the chart, the reality is last week's light trading was not much of a lead as to the overall market sentiment. But nonetheless, a rally in US shares on Friday night saw the S&P 500 finish up a little over 1% for the week. The ASX, the Australia 200 index, outperformed last week, largely on the back of strength in global mining stocks. The ASX 200 up 1.84%, almost 2%. Last week, doubling the gains in the US broad indices. And interestingly enough, Hong Kong, which has been the high beta market for the last 6 months, actually finished down. It reversed direction, was down 0.6% or thereabouts for the week. So a mixed week of trading, but as I say, not much of a lead there given the fact that so many players were not in the game last week. We did see some very strong reactions in the share market locally and around the globe. And it's one of the phenomena that analysts are looking at very closely. Reactions to earnings announcements have been, in some cases, severe. We saw Zip last week miss on its earnings, and despite very strong growth, its share price fell by more than 35% at one stage. In contrast, Sonic, which has been under a lot of share price pressure over the last 2 years, reported better than expected. Its share price was up 10% in reaction. And while both of those reactions in the market have been moderated since, we're seeing this phenomenon again and again during the reporting season. It's very important for investors this week because we've got hundreds of companies reporting here in Australia and in the US as well as in Hong Kong. And the earnings reports are having such a dramatic impact on individual share prices, investors can't afford to not be informed about their companies that are reporting this week. So I urge every investor who has holdings to go to the earnings calendar in whatever center you're invested in and check to see which of your holdings are reporting this week because the reactions in the market have been dramatic. But we've also had plenty of action around other markets. Gold is on the climb again, above 5,100 again. We've got plenty of data this week to move markets as well. And most importantly for local investors will be the Australian CPI released this Wednesday. Looking around the globe, there's plenty of other data released. And given what's happening in the US at the moment, consumer confidence, which is released also on Wednesday night in the US, could also be an important market number. We also got plenty of earnings, as I mentioned, hundreds. A couple of highlights in the US. We've got Nvidia and Salesforce reporting, both of them very important to current investment themes. And here in Australia, we've got Qantas, Woolworths, and Woodside Petroleum all reporting this week, amongst more than 100 others. And so there'll be a lot to drive the markets. But at the macro level, we've also got some important drivers. On Friday night, the US Supreme Court ruled that the mechanism used by the White House to impose tariffs on other countries was in fact illegal, and those tariffs were struck down. Now, the market reaction was for calmness. We saw the volatility index fall in the US, and we saw share markets rise, and generally shares enjoyed good support on the news that those tariffs had been struck down. However, over the weekend, President Trump has announced he has a different mechanism for imposing tariffs, and not only did he reimpose the tariffs that were struck down, he increased them. The baseline tariff has gone from 10% to 15%. And so despite the fact that US markets finished in positive territory and futures for Hong Kong and Australia also finished trading on Saturday morning in positive territory, the news of the new imposition of tariffs over the weekend could mean that those positive moves will be reversed at the open this morning. So a good time to be on alert given this shifting sentiment around the potential for further trade wars as the US reimposes tariffs that were struck down by the Supreme Court. Now, that volatility that we saw last April could return on this news. The 15% tariff does represent an increase for a number of nations, including Australia, and a number of commentators have already indicated that this is unambiguously bad news for the Australian economy. We're looking at potential weight not just on shares, but on the Australian dollar. And given that the international participation in the Australian share market recently was largely driven by a positive outlook for the Australian dollar, that change in thinking about the outlook for the Aussie could weigh doubly hard on shares today. Now, possibly the biggest news this week in markets will be the situation with the US in the Middle East, and in particular, the threats that it's made against the Iranian nuclear power program and the potential for armed conflict in the Middle East between the US and Iran is elevated this week. And any news of a strike is obviously going to affect market sentiment. So something to look out for. Combination of tariffs and potential armed conflict this week means that investors should be on high alert for the news flow. We've also got the fourth quarter US GDP. It's expected that the US economy grew at an annual rate of 1.4%, well below the long-run averages, and of some concern given the persistently higher inflation. About 0.4% of that reduction in fourth quarter growth comes from the hit from tariffs, and is a reminder of how important potential tariff impositions can be to the market. Tech, mining and energy, most likely to be the sectors affected by any further reactive tariffs. And we're seeing more resilience for domestic-based businesses. So utilities, consumer-exposed businesses and property, all more resilient in the US and here in Australia in light of that international news. Turning to our watch list this week, Austal. It's a sad situation when defence stocks are top of the list, but that is the situation this week. And it's very clear that investors are anticipating further conflict around the globe. Austal shares are up 41%. Sorry, profit is up 41%, revenue of $1.1 billion, and a record-sized order book of $17.7 billion, mainly for the Littoral class destroyers that Austal produces. Its shares are up 29% last week. For the year, they're up 55%. It's leading the ASX 200 higher at the moment with a positive outlook. It's Australian orders that's actually driving growth, despite the number of US contracts that Austal hold. And a number of analysts have a buy rating on Austal. And given the potential for rising conflict around the globe, that's not surprising. I touched on Zip earlier and the very negative reaction to its results last week. It was quite curious because the stock was down 25% last week, despite the fact that it grew revenues by about 29% over the first half of its financial year. Its earnings, its EBITDA, were up 86%, and US customer growth was greater than 10%. And yet, for some reason, a number of investors and analysts have labelled this growth in Zip's business as not enough. So while it was priced for extraordinary growth previously, the moderation in its share price suggests that a lot of those expectations were taken out, and yet the market reaction to its result last week suggests that there were still elevated expectations around Zip's earnings. It did announce flat growth for the second half, and in a high growth stock, that's clearly not a positive. But nonetheless, a number of major investment banks around the globe, including Citi and Jefferies, have strong buy ratings on Zip. And essentially, for investors, this comes down to a choice. Is buy now, pay later a real business or not? If it is, you might be looking at Zip shares right now. Turning to another former market darling, Moderna was up 24% last week and led S&P 500 gains. Year to date, Moderna's up 69%, bouncing back. Now, this is essentially a vaccine business. It had its heyday way back in the COVID lockdown days. In August 21, it hit a high. This one has been figuratively decimated, and that reduction in the share price all related to the fact that it was basically a single trick pony, a vaccine business. However, the FDA has reversed its course on a vaccine review that the company had requested. And while Moderna did rely in the past on COVID-19, it is now according to management, developing a new pipeline of products, and at a much reduced share price, Moderna is a stock that's attracting investor interest once again.